Well, if everyone's ready, maybe we should go ahead and get going. We're at the top of the hour here. So I'm Scott Oath, Cahill Financial Advisors, and we're having a discussion today on investing with a margin of safety and First Eagle Investments approach, and have special guest Jay Lisowski. Am I pronouncing that right, Jay?
You are.
Very good. Jay's a senior vice president and head of product development with First Eagle, and has extensive role with the company and background, is expert in communicating, describing strategies. And very interestingly, found out when we were talking earlier that Jay earned his degree in finance from the University of Wisconsin, my hometown. We shared some stories there, and he's also a chartered financial analyst. And also happy to have Greg Blenkush, sorry, Greg, joining us today. Greg's a colleague of mine. Greg and I have worked together for several years. I've always been very impressed with Greg's knowledge and thoughtful approach. And he and his partner, Michelle Damon, run a very nice advisory team with us at Cahill Financial Advisors. And Greg has earned an MBA from University of Minnesota and is also a certified financial planner. So should have a really good discussion here, and a few maybe just disclosures, things to get out of the way up front that our compliance team always wants to make sure that we cover. That this is a general discussion, just informational. Nothing here should be interpreted as specific individual advice. Seek your own expert counsel, do your own research, and we're idea sharing here. Or give us a call at the office if you want more detail or how any of this might apply to you specifically. So with that, I think you work for a very unique company, Jay, with a distinct approach. And there's a lot of discussion, there has been for quite a while, about, hey, why not just index? That's a very good way for many investors to capture the market. It's low cost. You eliminate risk of underperformance. It's very tax efficient. And most stock pickers, most investment strategists, most active managers can't beat the index anyway. And so I generally agree with that sentiment. I don't know, Greg, I imagine you might as well, that for a lot of people, it's a very good way to participate in the market. But that said, there are some active managers, some firms, some investors who've demonstrated, really remarkable long-term results, and have done that by, marching to the beat of their own drummer. I think, when we're looking to consider strategies that are different than an index, there needs to be a very compelling case, and showing that you're doing something unique that's giving unique exposure. And sometimes we look at it and say, even if returns end up in the same point after 10 or 15 or 20 years net of fees, if the pattern of returns is different than the market as a whole, than the way the herd is running, that can be a win right there. It's I feel like sometimes the third spoke that's of portfolio design that's not given enough attention. You think about attractive rates of return, you think about volatility of the individual holdings, but that correlation component. And Greg, I don't know about you, but during the big down years we've had, it's nice to have components in a portfolio that are zagging when everything else is zigging, wouldn't you say?
I would agree. Yep. And there was a Vanguard study years ago that quantified the value of working with an advisor, and it was the behavioral management and the behavioral modification that was by far the most value of working with an advisor. So to your point, trying to smooth things out along the way and keep people invested even in a severe downturn.
Yeah, great. Well, hey, with that, Jay, would you mind telling us a bit about First Eagle?
Sure, happy to, and appreciate the opportunity to come on and speak with you guys today. So First Eagle is an independent, privately owned asset management firm with a heritage and a legacy that goes back to 1864. And so I'll give you the fastest 160-year history you've ever heard, sort of walking you through.
Take us back to the Civil War, please. Yeah,
exactly. So it was founded as a bank by a pair of brothers in Dresden, Germany, back in 1864. And the company has endured through world wars, hyperinflation, bubbles, all the different geopolitical and things that have happened in the world since then, until moving its headquarters to the U.S. in 1937, and moving all the way to becoming the global asset management business that we are today. And I think what's important there, and what's important about that heritage and going back as far as we do, is the concept of resilience, right? And to have a business, there's not many businesses that can say they have a heritage back, 160 plus years or 140 plus years. And I think why that's really relevant is the ability to endure all those types of various environments, right? Whether it's hyperinflation, whether it is world wars, whether it is bubbles in the market, recessions, depressions, all of those things, various political regimes, et cetera. All of that focuses on being able to be a resilient business over time. And so that's been the heart of what we've done. And the focus for us has really turned to being an asset management business and providing investors with what we believe is a differentiated investment solution. So the core of our global value team and the strategy that we bring was founded back in 1979. So again, a very long heritage of this type of global investing. And why I think that's also important is we started as a global investor, right? And so we actually, many firms started out as U.S. investors and over time sort of branched into the international markets. We've had a global approach to it since day one. And so that actually gives us that global perspective in everything that we do. Again, that also goes back to our history of being a firm that was founded in Germany, had global headquarters back before that was common, and allowed the firm to relocate to the U.S. From Germany during the 1930s, and obviously some of the challenges that Germany was facing at that time. And so I think, again, that type of firm, that type of focus on being an investor-led firm with our clients' focus as our primary goal of providing them differentiated returns.
Yeah, it's kind of interesting. One of the things when I think about First Eagle is sort of you're not subject to the, what I might call the tyranny of the style boxes. I think a lot of people, even fairly casual investors, have become familiar with this tic-tac-toe grid of large companies, mid-sized, small companies, growth and value companies. And, as I look at that, it seems to me that came out of a good idea. You had investment consultants decades ago who were saying, how do we measure performance? How do we benchmark companies? And so they started categorizing different investment strategies by the size of companies, or whether they're focused on growth stocks aiming for outsized returns and rapid capture of market share, or underpriced securities. And so these style boxes came into play. And then it seems to me what sort of happened is investment manufacturers started designing products that were very specific in each of these style boxes. But if you look at some of the research, one that goes back, guys, about early in my career, I remember hearing about, I think it was Biebauer, Hood, and Brinson study about, something about 92% of the variability in a portfolio's volatility and expected return can be attributed to its asset allocation. It seemed to me that a lot of the very strict style box oriented funds, you're really handcuffing that manager and you're locking them into a specific style box. First Eagle, a lot of what you do is very broad. You mentioned global. It's all across the world. It's up and down the size chain. You do have some specific styles in terms of how you select companies within that, but is that a fair assessment?
Yeah, it is. And we think of ourselves as value investors, right? And what's a critical component there, and the founder of our strategy, Jean-Marie Eviard, has a saying that he used to say all the time, which is, value is a big tent. And what he means by that is that there's a lot of different ways to approach what is value investing. As you mentioned, there's style boxes, right, where you can look at things that are based on characteristics like price to earnings, cheap price to earnings, cheap price to book, or cheap multiples, of various different kinds. There's that type of sort of quantitative approach to value investing. And we've always talked about it as value as a philosophy, not as a quantitative style. And what that means for us is, again, in some version of value investing, you run a screen for cheap multiples, right? These are the companies that screen out as cheap companies. Then you look to see, is there anything in that list that we want to buy? We actually do it in the exact opposite direction. We spend all of our time analyzing the companies to find what we think are resilient, good businesses and what that company is worth. And then we wait for the right time to price discount to what that company is worth. That's the value for us. And so again, it's a slightly different nuanced version of value, but that also is what allows us to not fall into just only being pegged into that box of looking for cheap companies. We're looking for great companies and only buying them at the right price, at the right time, at a discount to the intrinsic value, which again, as you mentioned in the opening, you talked about, investing with a margin of safety. That is how we define a margin of safety. We talk about it in terms of understanding the business, understanding what it's worth. We call it the intrinsic value. A simple way of saying it is the intrinsic value is what a knowledgeable investor would pay to buy the entire business or replicate the entire business. That's our intrinsic value. And wanting to find a discount to that value, we're typically looking for somewhere between 20 and 40% discounts to what we think that company is worth. That's the margin of safety, because again, you're buying in at that discounted price to what that business is worth. And that's what we believe allows us to have resilient businesses over time.
Yeah.
As a global asset manager, your investing landscape is, well, very, very large. How do you identify companies? How do you siphon off the tens of thousands of companies down to a more manageable number to really do the in-depth analysis on?
Yeah, so the key for us is there's a couple of aspects to it. One is our long-term approach, and because we have a turnover in the 10 to 20% range, we're typically looking to hold these companies for 5 to 10 years. And why I bring that up is because we're looking for, we're not looking to be buying things that are going to be for the next month fantastic trades for us. We think of ourselves as investors in the business, not just buyers of the stock. And that also speaks to, and again, why I bring that up is because that speaks to sort of the pace of how we're finding names. To your point, there's a lot of names out there. It can take a long time to find the right businesses and get the right price. But because we're not looking to constantly churn the portfolio or make a lot of trades, we can be patient and take our time to do that deep research on those companies. So we look anywhere in the world, and then I'll get to sort of the key point here, right? So then what is it that we're looking for? So we're very patient in how we go about that. And we have very experienced analysts and portfolio managers that spend all their time scouring the world for these companies. But at the end of the day, there's sort of three main things that we're looking for to get to the right businesses. The first is scarce assets, right? Something that is hard to replicate. And whether that is a tangible asset, something that, a company that owns tremendous property in an oil field that is really hard to replicate for someone, or timberland. If you own more timberland and ability to continue to grow trees and continue to generate that timber, that's a scarce asset that's really hard to replicate. Or it could be intangible, right? It could be something that's more very strong market demand, very strong sort of market share, a dominant market share in the place, or a sticky customer business. Think about things like your relational databases, right? It's a real pain if you're going to shift what company is sort of supplying your relational database and getting that technology and the pipes connected and so forth. So that's a very sticky type of business. Or you have a company, take an example like a Shimano. Shimano is a Japanese company. They control about 60% of the world's global bicycle gears and brakes business. Right? So again, very dominant market share in terms of what they do overall. Again, things like that give you scarce assets overall. Second piece of that is to layer in the debt level and the balance sheet of these companies as well, right? You want to make sure that you have manageable debt, you have a good balance sheet with those scarce assets. Scarce assets generally will help create cash flow. You want to make sure that the creditor doesn't end up owning your scarce assets because you're over leveraged and have too much debt in the portfolio. Third piece of it is the management company itself. Now, if you have scarce assets, if you have low debt, you should be generating pretty consistent and strong cash flow. And you want to make sure that you have a management team that's capable of executing with that cash flow, whether that's returning it to shareholders, making smart acquisitions, reinvesting back in the business, things like that allow you sort of a consistent and persistent business for us overall. Those are the three key things that we really look for in terms of finding the right companies, resilient companies overall.
It's really remarkable, remarkably low turnover compared to a lot of your peers. I mean, you said 10 to 20%. I don't know, offhand industry averages are multiples higher than that. And, hand in hand with that, your average holding period is very long. Is it something like 10 years in many of your strategies?
It is. It's 5 to 10 years overall. And there's absolutely names that we've held for close to 20 years.
Yeah.
And we do, again, we do trim back positions over time if they're doing really well. We do add to positions on weakness and so forth. But it is, again, we look to be long-term business holders as opposed to sort of making near-term trades. Because again, we believe our strength is in understanding the good companies and when the right time to buy them is, as opposed to trying to predict what's going to happen in the next month or the next quarter.
So there's a debate within the investment industry. There's a school of thought that says, you should have a certain portion invested in international stocks, international equities, get global exposure. Talk about, half the world's assets are outside of the US. Especially, we're talking about peer groups and style boxes versus independent thinking. And then there's sort of a counter argument saying that, a lot of the dominant companies are based in the United States and they're earning their revenues overseas and globally. And so it doesn't necessarily matter where the company's domiciled. Would you say First Eagle adopts either of those approaches, or maybe a third one where you say, we don't care, we just want to find great companies. We're not targeting any type of weighting or allocation. We're looking for the excellent company and pricing it out and seeing if it's a fit that way?
Yeah, our approach to it is absolutely that of we want the best company regardless of where that company is. But one of the things we say a lot of times is that the U.S. doesn't have a monopoly on good businesses, right? There's certain parts of the market, like technology, where the U.S. seems to have a sort of dominant share of some of the best companies in the world. But if you go into things like industrial robotics, there's Japanese companies like Fanuc that are absolutely market leaders on a global basis. They happen to be located in Japan. Or if you go to some of the consumer packaged goods companies, take a Danone or a Nestle or something like that, those are global businesses that are driven completely by all over the world, and yet they happen to be located in France or in Switzerland. And so it really doesn't matter from a domicile perspective. And I think it's also worth pointing out, we've been through a cycle now, and 2022 maybe sort of broke some of that cycle, but we had a period there of almost 15 years, a little over 15 years of U.S. dominance, right? And the U.S. outperformed the international markets by 220 some odd percent over that period. That's an exceptionally long period. That's exceptionally significant outperformance. But the prior 7 years to that, the international markets outperformed the U.S. markets by about 70%. So the cycles do switch, and there's a period back in the 80s where it was about a 6-year period in the 80s where international markets outperformed the U.S. markets by over 400%. So you do get these periods, and sometimes long. We haven't seen one quite as long as the one we just went through, but you do get these periods of time where the market sort of shifts between U.S. and international. And that's why, again, to us, it's more about focusing on finding the right companies, because even within those pockets, right, even within, in 2021, there's a stat that it's somewhere in the range of 80% of the top 50 names in the MSCI World Index. So again, a global index, 80% of the top 50 names were actually international names. Now, that's during a period where the U.S. actually outperformed significantly, because those names at the very top outperformed by massive amounts. Yeah. But there's still a significant amount of those international names that were good investments. And again, it sort of speaks to where there's pockets of opportunity and where to find the right companies at the right time.
Yeah, and of course it matters how you are weighting them, because that larger number of international companies that outperformed, you may have larger holdings in those versus the benchmark, which is market cap weighted and dominated by those big technology companies. Yeah, very interesting. You reminded me of something, maybe a lesson in recency bias, or 20 years ago, 25 years ago, early in my career, I remember seeing what we call Ibbotson charts, the classic chart which shows a line going upward for different asset classes, cash, inflation, bonds, stocks, small company stocks, and international stocks were way up there. And you'd look at this and you just took it as gospel. Oh, higher long-term returns for international stocks. and then and then it didn't happen. It didn't happen. Didn't happen. Didn't happen. Now we've had 20 years the other way, really, and so very interesting what you point out about that run in the 80s. And I think the 70s as well. There's some good returns internationally, while the U.S. was struggling with inflation, high interest rates, 50% stock market crash in the 72, 73. Some things that sound kind of familiar, but
I was just gonna say some of that really does sound kind of familiar to what we're hearing today, doesn't it?
Yeah.
Hey, would you say that you are finding more opportunities than outside the United States, just given the previous 10 to 15 year relative outperformance of US stocks versus international stocks in general? Is that where most of the new opportunities are presenting themselves?
Yeah, I'd say probably as a whole, that's probably a fair statement. But that being said, again, it's so idiosyncratic for the right opportunities that we're looking for. We are finding there are some opportunities in the U.S. too, and when you have dislocations in the market, it gives you opportunities. So I'd say on the whole, there's probably more tilt towards the international side, but it's definitely not that we're not finding any opportunities in the U.S. side.
So when you talk about valuation and buying with that margin of safety and how you select securities, there can be a very strong fear of having what's called cash drag, right? Having cash in your portfolio while the market is on an upswing. It's on a strong run upward. But you guys don't necessarily care about that. You'll hold larger amounts of cash. If you don't find the prices that you like for the companies, that discipline, and you're not going to overpay. Can you talk about how you think about holding cash? And I mean, some funds will target it. They think it's bad if they have more than 1.5% or 2% in cash. How do you think about that?
Yeah, for us, the cash is a residual of buying opportunities. So, and what I mean by that is if we're in an environment where the markets are running high, valuations are high, and there's not a lot of buying opportunities, not a lot of dislocations in pricing, we're willing to be patient, and our cash may build in those type of scenarios because we want to make sure that we're not just forcing money into things at the wrong price. And so if you take periods like 2017, where the market went basically straight up, there was almost no volatility. I think the market was up all 12 months. Valuations were sort of at extreme high levels. That's where our cash would sort of peak out at some of the highest levels that we've been, because there wasn't a lot of buying opportunities. But again, for us, it's about compounding over time, but being able to protect on the downside as well. So on the flip side, when we do get volatility in the market, that allows us to put money to work, and put money to work relatively quickly without having to necessarily sell anything in order to do that. Every one of our sort of buy and sell decisions is a single decision, a single direction decision, meaning if we're buying company A, we don't have to sell company B in order to buy company A. It's all about, is company A the right company that we want to be buying? We want it in the portfolio at this point, we buy from cash. And same thing on the out. If we're getting out of a position, we sell it into cash as well. So as a result of it, we probably do have a little bit more cash than some of our peers do on average. But that also contributes to some of our downside protection, but it also is what contributes to our ability to put money to work during those dislocations, which really, again, positions us for rebounding or recovery and long-term resilience in the portfolio, because we're buying into names, quality names, that sometimes get beaten up or sort of washed out with everything else.
Yeah, kind of that idea of making money when you buy, not necessarily when you sell. Yeah.
Exactly.
Does the fact that short-term interest rates have obviously come back up to a level we haven't seen really in 15 years, does that change the portfolio manager's view as far as the margin of safety, how they're valuing companies?
Yeah, it definitely does to some degree, right? I mean, I think again, in some ways for us, the companies that we focus so much on, companies that have low debt levels. And so obviously with rates going up and that obviously putting pressure on some of the debt servicing for a lot of the companies, for us, again, having lower debt, it's a little bit less impactful, hopefully, in general for the type of companies that we look for. I think that it also, again, we're trying to be modest about what we expect the company to grow. Again, when we calculate the intrinsic value, one of the things that's important is we do it based on exactly the conditions that are in the market today, or sort of everything that's on the balance sheet today. We don't try to predict what happens if the company grows, what happens if the company doesn't grow. We look at what is the company worth today as it stands, and then hopefully if the company does grow, we're actually getting that growth as sort of a bonus on top of the discount of what we're buying it to, if that makes sense. So we don't do sort of some of your traditional dividend discount models that would be using a higher rate to sort of value these companies overall. It's slightly different from that, but the higher interest rate does come into play when we look at some of the debt ratios in those companies overall.
Could you comment on gold as an investment, as a hedge? First Eagle obviously maintains the gold exposure. What is it? How do you maintain that gold exposure? What exactly do you own?
Yeah, so the gold for us, gold is a hedge against market dislocations for us. And if you look back in time, you know, some of the ways gold has protected and been a store of value, right? So if you look at things like during the COVID drawdown, where the market was down, you know, 37%, gold was down like 3%. And last year in 2022, you know, the market was down 18, gold was basically flat for the year. It is there as a hedge against those market dislocations. And historically, what we found is actually the more the market dislocates, the more negative the correlation of gold is. Again, it feels a little technical, but just to walk you through sort of what I mean by that, right? The bigger the drop in the equity markets, the more opposite the direction of gold goes. So if you go back to like the tech bubble bursting, when the markets were down, you know, 50%, gold was actually up 16%. So again, the more the market has dropped, more gold actually has been up historically overall. So it is meant to be that's the hedge for us. It's not a speculative bet on the value of gold. It's more about the presence of gold as a protection. And as a result of that, we believe generally it's about 5 to 15% in our portfolios. 5% being probably not quite enough hedge on the portfolio. If you start to get up, you know, much over 15%, it's starting to be a directional bet on the price of gold, and that's not our intention. We want it to be there for the protection. And we have our exposure through two things. Through one, the physical gold bullion itself. We actually hold the gold bars, the physical gold bullion, and then we also use gold mining stocks and gold royalty type companies as well. And those companies are sort of, again, we look to figure out what the cheapest ounce of gold is. And what I mean by that is if you have a mining company and the mining company has proven gold reserves in the ground that they're yet to pull out of the ground, if you're able to invest in that company at a time when the gold price is a little bit depressed, as they pull the gold out of the ground, as the gold price recovers, there's sort of a magnified impact and return for those companies overall in the mining industry as well. So we're typically going to be about 2/3 in bullion, 1/3 in miners. That's sort of where we've been on a historical level, but it will fluctuate based on sort of valuations of the miners and where the gold value is overall. But that's sort of our general take. Like I said, it's there to be a mitigation of downside volatility.
How long has that type of gold strategy been part of First Eagle's approach? Does it go back to 1864, or did it come in somewhere along the line?
Yep, that's been part of our heritage for our primary strategies back since their inception in 1979. Mm-hmm. It's always been part of our belief of providing that downside volatility protection.
Mm-hmm. This may be a little off track, but so you are seeking the best price for an ounce of gold, whether it's buying the physical asset or buying exposure through related companies. You know, what about folks who see the commercial on the late night TV or open the magazine for buying, you know, coins, or any opinion or thoughts to share for people on that?
Yeah, again, I think that we think gold has a place in a portfolio. Now, again, the ways that you want to access it, you know, again, with our scale, you know, we're able to buy the actual gold physical bullion bars. You know, again, some of the gold coins and things like that, there are ways to own it. And that can get you the exposure that you're looking for. But there's also, again, through the things like we do in some of our commingled funds that get you more pure access to it.
Yeah. Well, in so many things, you can have something that's an attractive asset or company, but then what's the price to access that? And
Exactly.
oftentimes there's some ways are much better than others, and size can come into play there. And speaking of, that's something we didn't really touch on, but with the history of the company, things have progressed. Maybe just a quick bit, you tell us give us a little thumbnail on size of the company, your research team, employees, assets, anything that might be relevant to help understand.
Yeah, definitely. So right now we run a little over 120 billion, or right around 120 billion in assets at the firm. And our team, the global value team, we have our portfolio manager, the co-heads of the team. We have two co-heads of the team, and we've got a research team it's about 30 individuals. And it's a sizable team. It's a very experienced team, and we actually have coverage across equities, investment grade bonds, high yield bonds. We have sovereign bond analysts as well as a dedicated trading team, and some research operations and ESG analysts as well. And I think again, it's a group that I think is very experienced, and it works across all those different platforms to give us the most complete view of the companies that we're researching, right? So in many ways, people look and say, well, you have a mostly equity portfolio with, you might hold some cash, you might hold some gold, and just a little bit of a smattering of bonds here and there, or sovereign bonds here and there. Why do you have sort of this group of analysts beyond that? But it really does help us get a deeper understanding of the entire company and of the entire markets. And again, we have a team of sovereign analysts that give us a really good window into understanding sort of currency movements, weaker currencies, and how that could potentially impact some of the returns that could be in the portfolio from some of the international holdings as well.
Mhm. Mhm. So, maybe shifting a little bit, with your broad team and being able to look across areas, having that in-house capability, even if it's maybe not your emphasis. I think we talked about maybe some big picture type thoughts. Do you have analysis of where we're at in terms of the economy and the markets?
Yeah, it's a again,
Interesting stuff
one of
going
the
on.
things. Yeah, no, it's a one of the things we say all the time, right? Is that our crystal ball is foggy at best, and why we say that, right, is there's so many moving variables, and it is challenging from a macro perspective to predict sort of the direction of a lot of things, whether it's interest rates, whether it's inflation, the earnings growth that's out there, and the geopolitical risks that are out there. But as a result of it, we want to be as cognizant as we can of all those things, right? And you look at sort of where we are. You have inflation that has come down. The latest reading, I think, was at 6%. It's come down from 6.4, but that's 6%, and that's still well above the sort of 2% target that they started talking about, a couple of years back. And so it is persistent and stubborn inflation in the market, and rates are higher, right? They've come back down a little bit as well, but you still have elevated rates relative to when we started sort of the tightening cycle. You still have an inverted yield curve, which again, the inverted curve doesn't always portend a recession, but no recession has ever happened without an inverted curve. So there is some risks to the economy overall. Earnings growth is down. So you do have some of these sort of bigger picture challenges, but inflation remains, unemployment, and the employment picture remains relatively positive. And then you look at sort of what the market did this quarter, in the first quarter, of being up, 7-8%. So pretty resilient in the face of some of these challenges, not to mention the banking crisis, right? So we had the concerns in March with Silicon Valley and Signature and some of the banks, and pressure that got put on, First Republic and so forth. And all that said, the market was still up for the quarter. So again, it's been sort of this choppy, uneven environment. And when you put all that together for us, that leads us to sort of expect a continued choppy market, some continued volatility in the market, where you get some of these pops up, but you do get some pullbacks when sort of sentiment goes the other way. And the market seems to be moving quite a bit based on where rates are, right? So rates fall, the market sort of rallies, the more growth end of the market sort of runs with it. People get concerned that believing that the Fed is going to pause or start to lower rates, that drives some of that. Well, then the next Fed meeting comes and they actually raise rates again, and suddenly the market sort of pulls back again and says, wait, maybe they're not done, and more, the other parts of the market sort of get a little beat up or potentially sort of pull back. And for us, again, it's a lot of uncertainty, and trying to put those pieces together, that just leads to volatility and choppiness in the market. And that to us keeps us focused on the long term and not trying to predict it on a month by month, quarter by quarter basis, and finding the right companies, the right resilient companies to be able to make it through that type of environment, because we do expect continued choppiness based on all those things. And actually, I didn't even mention geopolitical, right? We haven't even got to, and we just talk about sort of our economy. We haven't even talked about sort of anything going on with China. We haven't talked to anything going on with the Russian-Ukraine conflict still going on, things, that could potentially pressure and change the U.S. dollar. The U.S. dollar has been extremely strong, and you're starting to see some things that could potentially show some significant weakness in the dollar going forward, which could be a benefit to some of the international companies as well. Not to mention the whole U.S. political scene on top of all of that. So again, I think it's one of those things that it's not doom and gloom per se, but when you start to put all those pieces together, you get a lot of volatility, and a lot of uncertainty of sort of where that and how that plays out.
And getting back to inflation and current interest rates, if inflation is more built in, harder to bring down, interest rates stay higher for longer, do you feel that that's factored into equity prices in the US and globally, or could that be potential headwind, just a consideration as far as, what asset class, what type of investment is going to provide the most safety?
Yeah, I think that still could produce a headwind for some of the equity markets overall. But again, I think that's where you want to look and see, do the types of companies that you're investing in have pricing power? Do they have the ability to sort of weather that type of more challenging environment? Do they have low debt on the balance sheet? And it speaks to, again, Scott, some of your comments in the very opening, right, around active management versus sort of passive and just getting market exposure. Over the past, decade or so, having just beta exposure has made a lot of sense in a lot of parts of the market. And I think as we start to talk about some of these things and where the risk and the volatility can be, there's absolutely parts of the market, and some of it is in the international markets in particular, where an active manager is sort of making sure that you're paying attention to those type of selectivity things of, do they have the ability for pricing power? Do they have low debt on the balance sheet? And what is the impact of inflation and higher rates on those businesses really can come into play.
Do you have any thoughts on the banking situation, maybe in the US and throughout Europe or throughout Asia, as far as, is that, has that been factored in? Are there potential skeletons in the closets there that just, we can't even imagine what they're going to be at this point?
Yeah, it's been a very interesting, sort of, I guess it's been almost a month now since it sort of all came to light a little bit. And I think some of the things that happened with, Silicon Valley Bank, some of the things that happened with Signature were a little idiosyncratic in terms of those businesses, right? You had Silicon Valley that had, I think, 90% of their deposits were from, the same industry type of deposits. I think it was 80+% were above the insured level. And those are extreme levels relative to any of their peers.
Right.
And some of those mark-to-market losses they had were pretty significant, and which again created the run on deposits for them, which really was sort of the death blow for them. I think, but what it did do is it did shed some light around diversifying those businesses and diversifying the deposit bases and sort of understanding the losses and the impact of the rising rates on those companies. We've been fortunate from the standpoint of, generally speaking, and relatively over the long term for us, we haven't had a lot of exposure to the banking sector, the banking industry broadly. Our financial exposure has been more in insurance companies, more like asset management service type companies, or things that are sort of more holding companies that get classified as financials. That's been more where our exposure is, in part because of the challenge of, again, use a black box type of scenario. It sometimes does feel in some of the banks, in particular some of the larger ones, a little bit black box in terms of where their earnings are coming from and how to dissect that overall. So it's been an area that we've sort of avoided. But as we look at it currently, and what does that mean going forward, right? All eyes have started to turn to commercial real estate and what the secondary impact is. And you have a lot of leases, coming up due in the next couple of years, and with the rates at very different levels and how some of these leases and properties were financed to begin with. And I think that there's a significant pressure on that part of the market going forward. And I think there's a lot of, to your point, I don't know if it's skeletons in the closet, but people are starting to see a lot of potential ghosts coming out of those closets of what could be really strong pressure in that part of the market going forward.
With that, you said you typically don't have a lot of exposure to banking. Haven't heard you mention real estate, other than that this could be a spillover effect from banking into real estate. You keep cash. You've mentioned volatility. I guess what I'm getting to, or wondering if those are things that may be emerging as opportunities, saying we have cash on hand. We like to buy things cheaply when they're 20, 40% below their intrinsic value. Do you see potentially looking more at banking and saying there's opportunities there, or commercial real estate, or is it more that's not part of our long-term focus? We're probably not going to deploy much capital in those sectors.
Yeah. So the short answer, sort of philosophical answer, is we absolutely would be willing to look in if there was good value there. Mm-hmm. The slightly more nuanced or longer answer in this current sort of situation and environment, we're probably not finding great opportunities in that part of the market yet. Again, partly because we're not exactly sure of all the different things that are going to come out of it and fall out from it. And so we talked about the low turnover and sort of our patience as well. We're also patient from a standpoint of we want to make sure that we have a good sort of understanding of the viability of those businesses and their ability to generate consistent cash flow going forward. And obviously some of that is pressured right now, and we don't have great visibility into it. And so I'd find it very challenging for us to feel comfortable moving into those parts of the market because of the risk, right? It's a bigger hurdle, and generally speaking, for us, the more risky or the more potential risk that we see in a type of holding means we want a wider margin of safety before we'd be willing to. And given sort of the range of outcomes for some of these companies right now, we need a really, really wide margin of safety before we feel comfortable with it. That doesn't mean there's not money to be made. It's just that, again, for our long-term perspective, for our conservative approach to what we do, we're not willing to sort of take that speculative bet, if you will.
Mm-hmm. Mm-hmm. Two things I often talk about a fair amount when I'm sitting down with individuals and talking about their portfolio and their returns. And one is something that maybe Greg will figure out. I don't know if you guys have anything for us, Jay. And that's it. We report raw investment returns. I'd love to get to the point where somehow we're able to marry portfolio returns and then the tax return to show, after tax returns, the value of thinking about structure of investments or where they're owned. That's one part. But the other one is, there's a lot of focus on just raw return numbers. And I think it's so important to consider what volatility, what was the ride like along the way, both in terms of, Greg mentioned psychology and keeping people on the bus and comfortable with the portfolio, but also in terms of how dollars actually grow instead of just looking at the average number. And you talk about resiliency and that margin of safety. You have anything to share with us, Jay, in terms of that type of, the risk adjusted return and how you think about that, or maybe its importance to end investors?
Yeah. For us, we talk about a lot of our goal is to provide sort of, compound capital over time and avoid the permanent impairment of capital, which is a fancy way of saying, try to avoid losses. And what we mean by that really is exactly to your point. participate on the upside, participate in the market returns on the upside, but more importantly, protect on the downside, right? And it's sometimes it's the simple math that everyone knows it, but you don't always remember it until you hear it again, right? Of the simple things of, if you're down 50%, you need to go up 100 to get back to zero, right? If you're only down 25, you only need to go up 33 to get back to zero. And having to go up 100 versus having to only go up 33, but that's a very different, sort of future. And it's, again, the ability to compound over time by not having those losses is I think, a critical aspect of what we focus on. It's why we have the gold. It's why we at times do have some cash in the portfolio. And it's really why we focus predominantly on those resilient businesses, because of that ability to protect on the downside and the importance of that. Again, for us, we do definitely, there's the psychology aspect of it, right? Of for us and for our clients, our goal is to provide sort of an understandable return pattern, right? Meaning when the market is rallying with extremely high returns, led by sort of growth or more speculative parts of the market, we're not going to be able to keep up in that environment, and we don't expect to. But we still expect to be able to grow. We still expect to compound your money when those markets are up, maybe just not as much as the market in that huge up market. But when there is volatility, when the market does decline, we do expect to be able to provide some level of mitigation of that downside volatility. And that's what hopefully gives us over the long term, the returns pattern and the outperformance over long periods.
Mm-hmm. Mm-hmm. Yeah.
I think that's a good point, because I look at 2022 calendar year, if you had a growth stock portfolio, you might have been down 40%. Now, the first quarter of 2023, you might have been up 17, 18%, but still mathematically, you're still down close to 30% over that window of time. So to your point, it does make a difference when you have those big drawdowns as far as trying to recover what you've lost.
Correct. And then unfortunately, right, the drawdowns happen. It's there was a stretch in I guess it was probably in 17 where people started to wonder, does that happen anymore? Because we had a pretty good run, but as we saw again in the fourth quarter of 18, as we saw with COVID in 2020, as we saw in 2022, like those windows happen, and those drawdowns do happen. Unfortunately, it's part of the cycle. And again, being able to protect and also being able to put money to work in some of those dislocations, we think is really what contributes to sort of the long-term results we can produce for our clients.
Yeah, they definitely happen. My lifetime, 73, 74, 50% loss in the S&P 500, 2000, 2002, 50% loss, 2008, 50% loss. It's easy to say theoretically, as we're sitting here talking about, stay invested, it'll come back. It's a matter of time. It's now 73, 74, I was like in diapers and learning my ABCs. So I don't remember that one that well, but the other two I definitely remember, working in this field, and it feels a whole lot different when you're living through it, and it takes an awful lot of fortitude, and it takes a lot longer to come back with the high volatility portfolio that suffered those severe losses. And even the more minor ones, like Greg mentioned, last year or 2020, having a bit less on the downside makes a big difference, both in terms of the experience and that time to get back to break even, for sure.
Do you have any thoughts on dividends as a component of total return? In the US, it's really hasn't been the focus the previous 10 years, but historically, dividends have made up a pretty considerable percentage of your total return over and above capital appreciation. Do you have any thoughts there?
Yeah, for the majority of our strategies, it's not a key focus for us. But I agree that there is a component. Again, it's part of what I talked about with a management team, right? And assessing the management team of what do they do that's shareholder friendly activity. So if you're generating cash, what are you doing with that free cash that you're generating? Are you paying it back via dividends? Are you making smart acquisitions? Are you reinvesting in the business? So it is something that we pay attention to as being an intelligent way for management teams to return capital to shareholders. And to your point, in environments that we're in, those growth environments with really big returns, the dividends don't seem to be as vital. But as you get into a more choppy environment and more modest returns, the dividends become more and more important, right? right? And again, as we just talked about, I think given the environment that we're in, we're probably more likely to see a more choppy environment than we are to see sort of that rip-roaring environment, which again makes the focus of dividends a bigger component of the potential returns.
Well, this has been great. Maybe it's always kind of fun to hear, if there's anything to share, any favorite names or stories, things you're looking at or hold, that anything interesting you can share with us.
Yeah, no, again, I think it for us, and I'll give you a couple of stock examples of the types of companies that we invest in. And some of these are names we've held for a little while. But if you take a company like, Hoshizaki. Hoshizaki is a Japanese company, and they do a lot of kitchen equipment and predominantly like ice machines and coolers. And it's, again, a very resilient business. They're in a ton of dominant market share in terms of hotels and things like that. So the next time you're in a hotel, sounds like an odd thing to do, but go take a look at the ice machine, and there's a decent chance that there's going to be a little penguin logo on it with the Hoshizaki label on it. Again, that type of sort of strong cash flow business. It's a relatively smallish type of company, but very dominant global market share and very consistent, right? And hotels need ice machines, whether you're replacing them, whether you're servicing them, whether you're building new hotels and putting new ones in. You need that type of equipment in those places. And so, again, it's a solid, resilient type of company overall. And the other one I'll mention is a company called Schindler. It's an elevator company, a Swiss company. They are very dominant in the market share. They're one of 4 global players that control, I think it's north of 80, almost 90% of the world's elevators and escalators business. And when you talk about sort of a resilient business there as well, whether you are building a new building and you have to put in an elevator, whether you're renovating an old building and you have to either replace the elevator or service the elevator, or if you decide I don't want to do renovations, most regulatory environments still require you to service and maintain those elevators and escalators in those buildings. And so there's a part of the business that's extremely cash flow generative because, again, there's a demand and need for those services in just about any type of environment or just about any type of economic condition. And so that type of company, again, those type of businesses are the types of businesses that we look for being strong cash flow generative businesses overall. And again, we have things like, when there's pressure on the Asian real estate market, right? The Schindler traded down as a result of it because anything related to real estate was trading off. Well, as we just talked about, very strong cash flows. It gave us a buying opportunity for what we think is a really, really good business overall.
That's great. Very, very interesting. Yeah, no one wants to take the stairs anymore, do they?
Exactly.
Keep those elevators running. Yeah. Greg, any other thoughts or questions you want to share?
No, maybe just one final question, Jay, as far as you mentioned a choppy market, a lot of volatility. Are the portfolio managers, are you hedging currency? Are you expecting perhaps the US dollar on average to fall in value and for that to benefit some of the international holdings in particular?
Yep. We do typically do a little bit of hedging on the portfolio. We typically will hedge the yen and the euro. And we do sometimes have a little bit of a pound hedge on specific names. Right now, our hedges are at very, very low levels overall. Again, to your point, given the strength of the dollar, given some of the potential pressures on the dollar, we have very, very little hedge on at this point. And we want to make sure, again, it's there. The hedges for us are there to make sure that we don't lose good returns due to currency movement. So we don't, hedging can be expensive if you're trying to hedge the entire portfolio. It's why we do it at a measured level. And it's why we, again, right now they're at very, very low levels.
All right. Well, can't thank you enough, Jay. It's very interesting and informative. And thank you for sharing the time. Greg, thanks for joining on the call around the office. For anyone who's listening in, we will have this recording. I'll post on my my blog, scottoath.com. I'm sure Greg will have it to share as well. And until next time, thanks all.
Bye.
Thank you.